Let me tell you a story about two traders. Both started on the same day with the same capital. Each had $100,000. Both had the same strategy. Both had the same level of knowledge. Both traded the same pair under the same market conditions. 6 months later, one had $145,000 and was trading calmly every day. The other had $23,000 left and was seriously considering quitting. What separated them was not intelligence, not skill, not luck. It was a single shift in how they thought about trading. One was focused on making money. The other was focused on not losing it. And that difference changed everything. Meet Sarah, 29 years old, smart, motivated. She saved for 2 years to build her trading account to $100,000. And when she finally started trading full-time, she had a clear goal. She wanted to turn that $100,000 into $150,000 in 6 months. 50% return. Aggressive, but possible, she thought. She had a good strategy. She knew what she was doing. And she believed that if she stayed focused and took every good setup, she could hit her target. So that is what she did. She traded with size. When she saw an opportunity, she went for it. $10,000 positions, $15,000 when she was really confident. She was not here to play small. She was here to make money. Fast. She thought she had the right approach. The first month went well. Really well. She caught a few big moves. Her account went from $100,000 to $125,000. 25% gain in 1 month? She felt unstoppable. She thought she had figured it out. Trading was child's play for her now. This is it, she thought. I am on track. If I keep this up, I will hit my goal early. So she kept pushing. Month 2 started strong. Another $10,000 gain in the first week. Her account touched $135,000. She was feeling like a professional, like she had finally figured it out. And then the market shifted. A trade that looked perfect stopped her out. $5,000 loss. No big deal, she thought. I will make it back tomorrow. But the next trade also stopped her out. Another $5,000. Now she was down $10,000 for the week. And that bothered her, because she had been up $10,000 just days ago. So she did what most traders do. She increased her size. She needed to make it back. The next setup looked good. She went in with $20,000. It worked. She made back $7,000. She felt relief, but it was not enough. She was still down $2,000 for the week. So she took another trade, another $12,000 position. It stopped her out. Now she was down $14,000 for the week. Her account had dropped from $135,000. Still up for the month overall, but the momentum had reversed. And psychologically, something shifted. She was no longer trading to grow. She was trading to recover. She felt like there was a gap she needed to close. I need to make it back. Yet that was not why she started. Month 3 was brutal. She started the month at $121,000. She told herself she would be careful, conservative. But when she saw a good setup, the old habit kicked in. Big position. It stopped her out. $8,000 loss. And that loss triggered something. Frustration, anger, the need to fix it immediately. So she took another trade without waiting for her full criteria. Another loss, another $6,000 gone. By the end of the first week, her account was at $104,000. She had given back almost all of her gains from month 1. And now she was desperate. Because she was not just trying to hit her goal anymore, she was trying not to lose what she started with. But desperation does not make you careful. It makes you reckless. She kept trading big, trying to force wins, and the market kept punishing her. By the end of month 3, her account was at $78,000. She had lost 22% in 1 month. And now, the math became her enemy. To get back to $100,000, she did not need to make 22%. She needed to make 28%. Because percentages do not work in reverse. Losing 50% of your account means you need to make 100% just to break even. And Sarah was learning that the hard way. Month 4 was worse. She started at $78,000 and she knew she needed a big month. So she took bigger risks. $30,000 positions. Because she did not have time to grow slowly anymore. She needed to recover fast. And that mindset destroyed her. 3 bad trades in 2 weeks, and her account dropped to $55,000. Now she needed to make 82% just to get back to where she started. 82%, a number that felt impossible. And the psychological weight of that crushed her. She started hesitating on good setups, second-guessing herself. And when she did take trades, she was so afraid of losing that she would cut winners early and hold losers too long. By month 6, her account was at $23,000. She had lost 77% of her capital, and to get back to $100,000, she would need to make 335%, not 50% like her original goal, 335%. She was done, not because she did not know how to trade, but because she had no capital left to trade with. She lost the capital she had saved for trading for a long time in a short time, and despite starting so well. Now meet David, same age, same starting capital, $100,000. But David had a different approach. He did not have a profit goal. He had a loss limit. He told himself very clearly before he started, I can lose a maximum of 2% per day, 5% per week, 10% per month. If I hit any of those limits, I stop. No exceptions, no trying to make it back. The screen closes and I walk away. His goal was not to make $50,000 in 6 months. His goal was to not lose more than $10,000 in any single month. That was it. Protect the capital. And if he could do that consistently, he believed the profits would come naturally. He was not wrong. Traders focused on protecting their accounts make more profit than traders focused on making profit. This works almost like a law and applies to everyone. That is why we should focus on protecting our account, not growing it. Month 1. David made $8,000, 8% gain, nothing exciting. Sarah made $25,000 that same month, and David did not care. Because he was not trying to beat Sarah. He was trying to not lose. Month 2, David had a bad week. He hit his 5% weekly loss limit. His account dropped from $108,000 to $102,000, and he stopped trading for the rest of that week. Sarah would have kept going, tried to recover, but David closed his terminal and went for a walk. The next week, he came back calm, made $4,000, ended the month at $106,000. Month 3, David had his worst month. He lost $7,000, but he never came close to his 10% monthly limit. His account went from $106,000 to $99,000. He was slightly below where he started, and he was completely fine with that. Why? Because his psychology was intact. He was not desperate. He was not trying to recover. He was just executing his system and respecting his limits. What happened had happened, and he had followed his rules. That is what matters, he thought. Month 4. David had a great month. $12,000 gain, account at $111,000. Month 5, another $5,000, $116,000. Month 6, he made another $8,000, account at $124,000. Not the $150,000 Sarah was chasing, but $24,000 more than he started with, a 24% gain in 6 months. And more importantly, his largest drawdown for the entire 6 months was 7%. 7%. While Sarah lost 77% of her account, David never lost more than 7% from his peak. That is the difference. That is what capital preservation does. And at the end of the day, David was in a much better position than Sarah, both psychologically and in capital, because he focused on protection, not profit. And this protection did not just protect his capital, it also protected his psychology. That is why he was able to continue following his rules for a long time and end this process positively. On the other hand, Sarah was so focused on making profit that she never thought about what she would do if things went badly. She had no loss limits. She assumed she would win and was not prepared to lose at all. So every time she lost control. She acted as if something unusual had happened. David normalized losses because he accounted for them and prepared accordingly. That was the difference between them. Here is the math that most traders do not understand. When you lose money, the percentage you need to gain back is always higher than the percentage you lost. Lose 10%, you need to gain 11%. Lose 20%, you need to gain 25%. Lose 50%, you need to gain 100%. Lose 75%, you need to gain 300%. The hole gets deeper faster than you can climb out, and this is why profit-focused traders blow up, because they do not respect the math. They think if I can make 50%, I can also recover from a 50% loss. But you cannot. Recovery is exponentially harder than loss. Sarah learned this. David avoided it. If we focus on the sustainability of our trading life, ironically, we will make more profit. If we constantly focus on profit and winning, unfortunately, we will manage our trades worse because we are making plans based on a single possibility, and this implicitly instills in us the idea that we must win no matter what. That is why you move your stops. That is why you do revenge trading. You need to make peace with losing. You need to practice losing. Lose and learn to continue as if nothing happened. If your focus is only on winning and every loss is unusual for you, of course, you will do revenge trading. Because something you did not expect happens, and this causes you psychological pain. You do revenge trading to eliminate the pain, and this only causes more pain. It creates a vicious cycle. So practice losing. It may sound strange, I know, but if you prepare yourself for negative scenarios and practice them, your likelihood of doing something stupid after a possible stop loss will decrease and eventually end. Let's go even deeper into the reasons. Here is the psychological mechanism. When you focus on profit, you create urgency. You need to hit a target. You need to make a certain amount. And when you do not do that or when you lose, you feel behind. Whether you want to or not, you condition yourself to reach that goal in the shortest time, and this constantly forces you to take action. And being forced to constantly take action means making mistakes and ruining everything. Because at least that is how the process has reached its conclusion. That is why after all those account blowups, you also feel a relief along with bad feelings. Because it is concluded. You sabotage yourself by focusing on profit. And this rush to reach the goal approach also makes you take big risks when you are in the red. Because you try to catch up, you force trades, and forcing trades leads to bigger losses, which makes you feel even more behind. Because you know that nothing good comes from forcing. A spiral. A death spiral. And most traders do not realize they are in it until it is too late. But when you focus on capital preservation, there is no urgency. You are not trying to hit a number. You are just trying to not lose more than your limit. And when you lose, you stop. You do not try to recover. You just protect what is left. And that keeps your psychology clean. It keeps you calm. It keeps you in the game. Focus on protection. This will not create urgency, because protecting is easy. When you have a break-even day, it does not lead to emotional outbursts. It feels normal. So we need to change our focus. Here's another truth. You cannot control how much you make. The market decides that. You can have the perfect setup, perfect execution, and the market can still stop you out. That is probabilities. But you can control how much you lose. You can control your position size. You can control your stop loss. You can control when you walk away. And control is what separates professionals from amateurs. Amateurs try to control outcomes. Professionals control risk. Sarah tried to control her profit. David controlled his loss. And 6 months later, the results speak for themselves. Think about how much you will lose. Calculate the worst possibilities. Have loss limits. Daily, weekly, and even monthly. When you are sure you will stop when you reach those limits, this tells you from the beginning what situation you will be in the worst-case scenario. And if that scenario happens, you will have been prepared for it. So if that scenario happens, you will react more normally because you are experiencing something you already assumed rather than experiencing emotional outbursts. As a result, you will not sabotage your process. Let me show you the compound effect. Sarah's 6 months looked like this. Month 1, plus 25%. Month 2, plus 10%, then minus 14%. Month 3, minus 22%. Month 4, minus 29%. Month 5, minus 15%. Month 6, minus 10%. Big swings. High volatility, and a net result of minus 77%. David's 6 months looked like this. Month 1, plus 8%. Month 2, plus 6%, then minus 2%, net plus 4%. Month 3, minus 7%. Month 4, plus 11%. Month 5, plus 4%. Month 6, plus 7%. Small swings, low volatility, and a net result of plus 24%. The paradox is this. The trader who tried to make less actually made more, because trying to make more led to losing more, and losing more destroyed the ability to compound. David compounded slowly and steadily. Sarah destroyed her compounding in month 3 and never recovered. Sarah rushed because she was focused on profit, because without realizing it, She conditioned herself to reach her goal as quickly as possible. So when she lost, she increased her position size and sabotaged herself. David did not experience this because his goal was not profit, but protecting his account, following his loss limits. So he easily achieved his goal. And as a result of managing loss correctly, he made profit. That is all. Here's the professional mindset shift. Amateurs ask, how much can I make today? How much can I make this week? How much can I make this month? That question creates pressure. It creates expectations. And expectations lead to emotional trading. Professionals ask a different question. How much will I not lose today? How much will I not lose this week? How much will I not lose this month? That question creates boundaries. It creates safety. And safety leads to calm execution. Sarah was chasing a number. David was protecting a boundary. And the one protecting the boundary ended up with more. Do not think that focusing on loss leads to loss. I am not actually telling you not to have a desire to make profit here. It is just that if you constantly focus yourself on profit, you assume bad scenarios will not happen. And when those scenarios happen, you are unprepared for them. So you do more stupid things and ruin everything. Of course, we trade for profit. But first, we need to make plans to protect our account and our psychology, and apply our strategy. If you have a strategy you know is profitable, it will produce profit for you. All you have to do is manage losses correctly, that is all. Because when you focus on managing losses correctly, you generally manage profits correctly too. If it sounds interesting, definitely try it. The results will surprise you. Here are the rules David followed, and these are the rules that saved his career. Rule 1. Maximum 2% loss per day. If he lost $2,000 in one day, the terminal closed. No discussion. Rule 2. Maximum 5% loss per week. If he lost $5,000 in 1 week, he stopped trading until the next week. Rule 3. Maximum 10% loss per month. If he lost $10,000 in 1 month, he stopped trading until the next month. These limits were not suggestions, they were hard stops. And they saved him from himself. Because on the days he wanted to keep trading, wanted to recover, wanted to push, the system said no. And the system was smarter than his emotions. Here is what most traders do not realize. Capital preservation is not about being scared. It is not about playing small. It is about being smart enough to know that your account is your lifeblood. Without capital, you cannot trade. Without capital, you cannot compound. Without capital, you have no career. Sarah lost $77,000 in 6 months. That is not just money. That is 2 years of saving. That is her ability to stay in the game. That is her psychological stability. And once that is gone, getting it back is almost impossible. Not because the strategy does not work, but because the mind is broken. David protected his $100,000 like it was the most important thing in the world, because it was. And because he protected it, it grew. Here is the brutal truth. Survival is the real game, not profit. Survival. The trader who survives 12 months with consistent small gains will always beat the trader who doubles their account in 2 months and then blows up in month 3. Always. Because the one who survives gets to compound. The one who blows up has to start over. And starting over means you lost time. You lost capital. You lost psychology. Sarah has to start over. And even if she saves another $100,000, she will be starting with trauma, with fear, with doubt. David does not have to start over. He just keeps going. Calm, consistent, protected. If there is one thing I want you to take from this, it is this. Stop chasing profit. Start protecting capital. Your account is not a tool to get rich quick. It is your ability to stay in this game long enough for compounding to work. And compounding only works if you do not blow up. Set your loss limits, respect them, and when you hit them, stop. Do not try to recover. Just stop. Because the trader who can stop is the trader who survives, and the trader who survives is the trader who wins.